just want to make sure we have these relationships correct. We're now moving away from pluses and minuses on the accounting equation, and we're now moving into these T accounts. And these accounts will be used to record increases and decreases in various asset liabilities and stockholders' equity. So you notice that stockholders' equity accounts in general will increase by credits, decrease by debits. So that if we take each one of the stockholders' equity accounts separately and we look at them, you'll find out that if you start with the contributed capital, so when you start your business, you know that you invest. If you invest in the business, credits increase contributed capital. This could be common stock, for example. So if you sell common stock, it increases by a credit, and it also increases stockholders' equity. Revenues increase and gains also, but we'll just use revenues for now. Revenues increase equity, and they increase by credit. So everything on the right side here is consistent. People don't tend to have trouble with that. But where you do get a little confused is here. Debits decrease your equity. It decreases your wealth. So what I want to emphasize today is two things. One is that if you have an expense, you would debit the expense to reduce equity. But we always say that expenses increase by debits. So every time you debit an expense, you decrease equity. Dividends are the same thing. Every time you debit a dividend, you're decreasing stockholders' equity. So you just have to get used to this terminology. So when we increase an expense, it decreases stockholders' equity. When we increase a dividend, it decreases wealth. So we accumulate dividends, we accumulate expenses, and when we accumulate them, we debit them when they increase. And anytime you debit an expense, anytime you debit a dividend, it will reduce the stockholders' equity. It'll reduce your wealth. And just think about expenses. You have an expense, your wealth goes down. You distribute money to yourself. You take money out of your business, the wealth of the business goes down. Okay. All right, are there any questions on that? That was the last thing we left off on. I just want to be sure that that is clear and we don't have any problems with the notion of expenses and dividends. Okay. All right. Now, to be sure, as always, we'll try a couple of questions. So let's take the first one. And this is going to test you on the concept of a normal balance. Normal balance. We're going to go through this again. If these are easy, good. All right, I'm glad. So if the account normally has a debit balance, could it occasionally have a credit balance? So can there be exceptions? Okay. All right, so now what's the normal balance of an account while you're thinking? What does a normal balance mean? It's the account side that increases it. Whatever increases an account is called its normal balance. Can you have exceptions? Okay. All right, so we're about split on the class on this one, and it says that 58% of you believe that it could have a credit balance, and the others say that no, it can't, and the answer is A. It could have a credit balance. So as we said in class, it normally has a Normally, the balance is what you would expect, but there could be some exceptions. So, what's the Noel Bailey? Are you here? Noel? Okay. What's the normal balance of an asset account? Debit. Okay, good. All right. So, if we had a debit balance account, it's possible that it could have a credit. So let me give you a perfect example of that. Example would be, I mentioned this on Friday, your checkbook. Your checkbook, your cash account is your asset, okay, the asset cash. If you overdraw a check and you take out more money than you have, then all of a sudden that account has a credit balance. So an overdraft on a cash account could be a credit balance. Okay, thank you. Okay. So you could have a credit balance. All right, so let's go to the next one. Okay. Now, we just did this like 3 seconds ago. So let's make sure we understand this. Expenses increased by a debit balance, and that would reduce stockholders' equity. Okay, so I don't even want to wait a minute on this one. Here they go. Look at that, how fast they're coming in. You know, I'm only getting 178 responses. There are about 247 people in this class, so I want 100%. Okay, this should be easy. Should be easy. Now we're still going up now. Okay. All right. Okay, good. Well, yeah, most of you got it right. So we just finished that, and we said that expenses will increase by debits, but when you do increase an expense, it reduces your wealth. You got it wrong. Let's say it again. Expenses and dividends, although they increase by debits, any debit in a stockholder's equity account will increase, or at least will reduce the equity as those accounts increase. Okay, let's just do one more. Let's try this one. Which of the following statement is true of revenues? Okay, which of the following is true of revenues? All right. So let's see what happens. Boom. All right. All right. Okay. Class is good on this one. All right, so we're good to go. So again, I use this for myself just to make sure everyone's up to speed. So yeah, if you answered A, B, and C, just make sure you understand revenues increase stockholders' equity, just the opposite of the expense. So if it increases equity, it's going to also increase by a credit that is going to be its normal balance. All right, now we're going to move on to the next learning goal, but just a question here. I'm not going to do this one because I think it's pretty easy. We are going to be taking balances of accounts. So you realize that that has what? What balance does that have, a debit or a credit? Debit balance, and it should be 27.5. Okay, it should be 27.5. Debits minus the credit would give you the debit balance. So you have to take all of the debits, add those up, all of the credits, and subtract them, and that would give you the debit balance. Okay, and we'll see that now as we move along to the third learning objective. All right, so those are the rules of debit and credit. Now we're going to start looking at the actual bookkeeping procedures. Actual bookkeeping procedures use journals and ledgers to record transactions. I think I made it clear that it's obvious that you cannot expect to use an accounting equation to record hundreds of thousands of accounts. We need an information system. As I said, if you major in information systems, these are the kinds of systems that you'd be building. If you think about it, QuickBooks is built this way. Any computer software that deals with processing accounting information would be structured along these lines. So the first thing, when we record transactions, we're going to record them in what is known as the journal. The general journal is the book of original entry, and we use the journal just as you might use a personal journal to record transactions in chronological order and a standardized format. Now, some of the benefits here is that the journal keeps the transaction in one place, so that as we start looking at multiple accounts, you might, for example, we're going to look at the entry to invest in Smart Touch Learning, I guess it is, and you'd find that we debit cash and we're going to credit common stock. Well, we keep that together in the journal. When we break that up into the T accounts, cash could be on page 1, stockholders' equity could be on page 14, and you don't see the transaction together. So the idea is to keep the transaction in one place. You also have the events in the order in which they occurred, so you could trace them. If someone called you up and said, I ordered a product on this date, you'd be able to find it in the journal. You also helps you to locate errors. If there was ever an error in a transaction, you can go back to the journal entry and find it. You can make sure the debits and credits are equal. You make sure that the explanation in that journal matches up with the purpose of the transaction or the event. And again, as I said, if we only use the T accounts, it's going to fragment the transaction into pieces because, again, the cash account could be on page 1 and the equity accounts could be on page 30, and you're not going to find them unless you flip through them. What I mean by page, I mean electronically, just scrolling through page after page of information. So when we record a transaction in the journal, we say that process is to journalize. So if I tell you now on a problem or the next quiz, and by the way, don't be surprised, you get a quiz every Friday, so you should look, if you go on My Accounting Lab, the very first page tells you the next assignment is due 1 hour and 40 seconds from now, or 3 days and 19 minutes, or whatever it is. So just keep checking My Accounting Lab. So on a quiz on Friday, if I tell you that I want you to journalize something, it means you enter something into the general journal. And if you involve more than 2 accounts, it's called a compound entry. What was an example of a compound entry in our accounting equation? Well, if you remember, when the company paid $3,200 for expenses, they had cash, $3,200 going out, and they had 2 expenses. They had rent, I think, of $2,000 and supply or something else, insurance or whatever was salaries of $1,200. That's a compound entry, more than 2 accounts. Once that entry is in the journal, it gets to the T accounts from a process known as posting. So the actual process would look something like this. So the process would look something like this. You're going to wind up having a general journal. And the general journal is the book of original entry. So that's the first place you record the transactions. Then, if you wanted to go to the T accounts, and this is known as journalizing, the T accounts are going to be accumulated. And someone asked me, what's the difference between the accounts and the ledger? The ledger is a group of accounts. So the general ledger is a group of T accounts. And the process of taking the information from the journal to the ledger is known as posting. So that's the process. So the transaction goes into the journal. We will show you the journal entries in a minute. Once the entry is made, the second place it goes to is the ledger. And it goes to the various T accounts. Yes? Yeah, question? Yeah. Right. Well, what do you mean by, okay, the question is, do you zero out the expenses? So, yeah. Okay, I've got to understand what you mean by zero out. You mean the actual balance? You mean like the cash against the other two accounts goes to zero? Oh, I see. Oh, so that's an issue with respect to the software that's in the My Accounting Lab. Yeah. You know, I'd have to take that up with the publisher, and if there's points off of that, I could always get them back for you. All right, so just let me know. Yeah, let me know, because the problem, I'll get back to this. The problem is, in some cases, they're looking for zero. Sometimes they're looking for minus signs, and that shouldn't be. But if you email me that, I'll take care of it. Okay? Okay. All right. So, again, the process of going from the journal to the T accounts is going to be posted. So if you look at the process, here's where we are so far, where we have transaction occurs, you get your documentation. The documentation is analyzed, and then it is journalized, and it is posted. So this is the process we have so far in the formal accounting system. We'll get to the financial statements in a minute. Now, when you look at the journal entries are standard, and so are the T accounts, which we'll get to in a minute. So we'll talk about this in a minute. You'll see in just a second when I put this up on the screen. When you make a journal entry, and this is something, now this is not a publisher software problem, you've got to do it this way. The date comes first, then the debits. All the debits come first, and they are against the left-hand margin. All of the credits come second, and they are indented. And if there's an explanation, it's going to be also over on against the left-hand margin. So when you look at the journal itself, and I'll show you the entries in a minute, what you'll find is, oh, I'm sorry, let me go back to that one. Well, I can use this one anyway. So if you look at the journal, the first thing is the date, and the debits go against the left-hand side. Credits are indented and come second. And then the explanation is also against the margin. If you do it the wrong way, and even on an exam, I mean, maybe not in this course because we're doing everything, pretty much electronically, but if you are taking a course, you go on to major in accounting, you show up in intermediate, and you make a journal entry. If it's not done right, we can't grade it. We don't know if it's a debit or a credit. So make sure you follow that format. So let's take the first one. We're going back over the same transactions again. Here is an example of the sale of common stock. The sale of common stock is going to be for $30,000. Cash is coming in. The asset cash increases by a credit. You also now have an investment of common stock. Common stock is an equity account. Equity accounts increase by credits. So the journal entry is going to require that you debit cash and you credit common stock. So that's what the entry is going to look like. So again, the date, I don't care how you put the date in. It depends on the format. Cash goes against the left-hand margin because it's a debit, and then the credit is indented. And the sale of common stock is the explanation. And again, that is against the left-hand margin. So the question here about why do we do it that way, again, it's a standard format. We'll find out that electronically, if you do this on a computer system, these accounts, of course, have account numbers. On Friday, we looked at what? The chart of accounts. So I would know that somewhere in my computer system, the cash account is 101, and it follows through the system as 101. And we'll talk about those account numbers in a second. Okay. So any questions with respect to the first entry? Now, again, we did this on the equation. That equation is now gone. You can use it for analytical purposes, but from now on, you're going to be making this journal entry. Yeah.
So the reason why we put 30,000 for cash under debit is because cash is under assets and debit is under assets.
That's right. Yeah. So again, it's Mark. Mark. Okay. So you've got Mark. The question, if just to repeat, cash increases. Cash is an asset. Assets increase by debits. Okay, just to take that one step further, common stock is an equity account. Equity accounts increase by credits. And that's the way you have to think until it becomes like second nature at some point. Okay. All right. Okay. All right, so now we're going to post this. We're going to post this to the T accounts. And when you're posting this to the T accounts, we're going to get to the formal journal entries in a second. But you basically take the debit from the cash and move it into the cash account, and take the credit from the journal entry and move it into the stockholders' equity account. So let me just show you here first, and then I'm going to give you a better look on this as well. So if I'm posting, this is the posting process, I need to get the journal into the ledger. So the first thing I do is I take cash. Cash increases by a debit, and I move that into the T account. Now, remember the idea of the journal chronological order. The journal can also have the explanations. It could also be used to verify whether or not there's a mistake. If you look at the account here, this account could be on page 1, and that common stock account could be on page 15. So once you start posting, you fragment the information. However, that information is needed because we will eventually have all these accounts in order and have them ready for the financial statements. So eventually we want these accounts to be set up so that we can have them available to prepare the financial statements. So let me just give you an idea of what might happen. If you're looking at the general ledger, the general ledger would look something like this. So you'd have cash, accounts receivable, you might have office supplies, and then of course you'd have your liabilities, and then you'd have stockholders' equity. So let's say common stock. And then you'd have retained earnings. Now, of course, you'll have revenues and expenses as well. So what we're doing when we post them, we now have this general ledger. And the general ledger is a group of accounts. And of course, you'll have revenues and expenses. And so far, what we've done is we've debited cash and we've credited common stock. So you see what I mean by fragmenting the event. Now, of course, what would happen is I'll have a reference here that'll tie back to the journal, and I have a reference here that would tie back to the journal. So at some point, I could tie these together. But the journal is needed to keep the transactions in one place. And then from here, like right now, if I had to prepare a balance sheet, my assets would be 30,000, liabilities would be 0, and equity would be 30. So I could prepare the financial statements directly from the T accounts. And that's our goal eventually. All right, yes, question, yes, sorry. Yeah, that's the posting process. So basically what happened is that when this came in from the journal, okay, came in from the general journal, that's where we had the debit to cash. I'm not making the formal entry here. And common stock. We'll just abbreviate it. All right, so it's a good question. So that's the difference. The journal keeps everything in one place, then we split it, and we then post it to the general ledger. All right, so any other questions before we go to the second transaction? And by the way, it's the same effect as the accounting equation, right? Except that now we just don't have assets equal liabilities plus equity, but they do. They are equal. I mean, assets are equal to liabilities plus equity. Okay, any other questions or comments on this first transaction? We've got a few more to go. All right, next, if we remember back on our, and again, we want to use a pretty much a running example, a comprehensive and a continuous illustration. Transaction 2, they purchased land for $20,000 in cash. So once again, the repetition, you've got an asset, land, increasing by a debit, and cash is another asset, but it's reduced by a credit. So the journal entry should have a debit to land and a credit to cash. So if we now look at the transaction, it's going to have November 2nd, which is the date of the transaction, land, the debit comes first, it's up on the left side. Cash is credited, it's indented, and the explanation. Now again, remember, land increased. Land is an asset account, increases by a debit. The cash account is also an asset, but it decreased by a credit. Now, we're going to post this to the T account, so I'll get there, and then I'll see if you have any questions. All right, so here's the posting. And again, I know that I don't have the larger view right now, but that would actually be part of those T accounts we had before. Okay. All right, so now land has a balance of 20, and what's the cash balance? 10,000. So make sure you're clear about this, that debits and credits are subtracted. So this has a debit balance of 10,000. It's a $10,000 debit balance. So if I had to prepare financial statements right now, I've got cash of 10, land of 20. How much is my equity? Common stock of 30. So everything still balances. And although we're not doing it with an equation, you'd be able to do so at the end of the period when you pull all this together. And we'll show you how that's pulled together at some point. Questions on this transaction? Yep. Yeah, okay. It's a good question. Would the journal be a continuous page? Yeah. I mean, if you looked at journal, if we were still doing things with paper and pencil, it would be a continuous sheet. Now it's just a continuous flow of transactions on a computer. All right, so you'd be piling them up. Okay, another question. Yep. Yep. Yeah, debits first to the left, and then credits are indented. Yeah, and that's what I meant before. You know, in this course, unfortunately, within a second, this course, yeah, the question was that question? You want me to repeat the question? The question was the format, whether or not the debits always come first. They do. And they have got to be to the left. Yep. You have a question? Yep. Yep. Okay, you want to repeat the question? How did you find the okay? How did you find the cash balance of 10? Okay, so in our account here, we started with 30,000. The next journal entry, let me give it on a. Let's just take the cash account. This is transaction number 1. In transaction number 2, we wound up spending 20,000 for land, debits of 30 minus credits of 20 gives you a balance of 10. All right, so the question was, how do you find the balance? It's always the debits minus the credits. If the debits are larger, it has a debit balance. And is that the normal balance of cash? Yes. All right, it's an asset. It's got a normal debit balance. Have another question?
When you said that debits always go first.
Yep.
And you did the 20,000 was the cash for the land.
Right.
Now, what if there was like another debit transaction? Would it go
Yeah.
debit?
We're going to show that. I'm going to show you that example. Let's say you're talking about a compound entry. And we're going to show you the compound entry with the expenses. So I think we had rent expense and salaries or something like that. The rent expense is a debit. Salary expense is a debit. It goes to the left. And then, of course, the cash is paid out and it's credited. So in a compound entry, all of the debits come first and to the left. If there's 1, 2, 15 debits, and all the credits come second and they're indented. Good question. Any other questions? Okay. Good. All right, so now let's take the next transaction. And it depends. I got to make a correction here for you. In this one, they purchased office supplies on account for $500. Now, I think yours said cash or something. There was a typo in there. I pulled it out. So if you got this slide, 48, 2-48, make sure you pull out the word cash there because this is on account. And on account means what? Accounts payable. It means that you ordered but did not pay. So in this case, you bought an asset. You acquire an asset. An asset goes up by what? A debit. And you've incurred a liability. Liabilities go up by credits. So the entry is going to require that we debit the asset office supplies, and we're going to credit the accounts payable. So there's the journal entry for office supplies. And again, the word cash in that should not be taken. Yes?
Is there always going to be debit and credit, or can it be
Yes.
credit?
No, it's got to be debit and credit. Right now, debits equal credits is the same as assets equal liabilities for stockholders' equity. It's sort of like a law or a rule you have to follow. So debits and credits have to be equal. Okay. All right, so the next step is to post this. The next step is to post this. And once again, we're going to post this to a debit to office supplies and a credit to accounts payable. So the ledger is starting to build up. You're starting to build up the ledger, and all of these accounts would appear in that general ledger by posting. And right now, if I wanted to, I could go ahead and get the assets. I have $10,000 in cash, $20,000 in land. I've got $500 in office supplies. So you could see how that would be built. All right, so before we do anything else with questions, any issues on the debits and credits. And remember, these accounts are with this entire group of ledger accounts. And we'll show you that in the next learning objective. Any questions? Yeah, we have a question there. Yes. Yes. Let me get over here. Hold on. The software, yeah, definitely, yeah. You can use, they have everything you look at that's commercially available. QuickBooks and any other software is built on this model. Yeah, what will happen is if you're entering, if you were building an information system for a client, you would have to designate the way in which the individual, the data entry, the person that's doing the data entry. Some of them are very intuitive. Some of them are made for accountants. Some of them are made for non-accountants. So if you develop software for non-accountants, you would basically just say, put in cash and put in, the cash go up or down. But for someone that knows a little bit about it, they'd say, enter debit amounts, enter credit amounts. Right. Yeah, and that's all in the system. That's all in the system. Yeah. So, let me answer the question. Yes, if you, there are people that work in public accounting firms, and their positions will enable them to go out to clients and determine whether or not their systems are doing just that. So if you go to a cash register and someone swipes your credit card, lots of things happen. A sale is recorded. They have an accounts receivable from you. Inventory gets reduced. All of that happens instantaneously. And all of these accounts are updated. So, again, they may not appear this way, but it's still happening that way. Okay, still happening that way. All right. So are we ready for a couple of questions? So let's go to the next. Okay, now. All right, this one I'm just going to, we're just, after initially recording the transaction in the journal, it's transferred to the ledger. Okay, so the answer there is B. All right, now, answer is B. All right, now, here's the one I want you to work on. Okay. Which one of these would be the result of journalizing a transaction that purchases office supplies for cash? Okay. And let me just start this. Okay. All right, so let's get the question. All right, so yeah, I mean, it's going to be D. So, all right, so we're doing all right. Again, I just want to be sure if there's anything I have to explain again. Looks like I don't have to explain this again. So the answer is you're going to debit office supplies and you're going to be crediting cash. All right, anyone with any questions on that before we move ahead? All right, let's go to the next one. All right, a business renders service to a client and issues a sales invoice. The amount will be collected from the customer at a later time. Which of the following will be true when the invoice is going to be issued? Okay. All right, well, I don't know. Okay. Yeah, net income will increase. Now, I got to go through this one a little bit. Where's Esposito? Yeah, what did you do on that one? Did you get that one correct? And yeah, you're Esposito. You got it right. Okay, why? Yeah. What would be the journal entry on that one? What would be the journal entry? Yeah. Let me move this out of the way. All right, so it's a debit to what? All right, so he's got accounts receivable. What do you credit? Anyone? Sales or service revenue. So you debit accounts receivable, credit service revenue. So net income, of course, will increase. Now, of course, if income increases, if you got sales, stockholders' equity can't decrease. Liabilities, there's no liability here. And if you have a revenue, revenues are defined as inflows of assets or decreases in liabilities. So, it's got to be D. So the answer to that one is going to be D. All right. Let's move on to the next. All right, so we have a company now, Beatles Inc., makes the following entry, and I want to know, they debit cash, credit unearned revenue, and I want to know what's the transaction for that journal entry. What would be the transaction for that journal entry? Okay. Okay. All right, so yeah, everyone did all right on this one too. Okay, so it is C. So in other words, this is an unearned revenue, which is a liability, which means that they received $5,000 for services to be performed in advance, which means it's an advance collection, which means that it is a liability. Okay. All right, and finally, the last one is, I'm not going to ask you this one, but this one is just a little bit different from the one we had before. Here you got office supplies that are purchased, but instead of paying cash, you are buying those on credit, and therefore, if you buy office supplies, the asset account office supplies go up, so therefore you debit that, and you're going to credit accounts payable. So the answer would be B in that case. Okay. All right, now, before we move ahead, anyone with any questions on the debit and credit process, the journaling, the journalizing, and posting? Okay. All right. Now we're moving on to the next part of the process. So the way it's going to work in this cycle is that you have a transaction, you have the document, you analyze it, you determine whether accounts are increasing or decreasing, whether they're asset, liability, or equity accounts. Those accounts are then journalized, posted, and now we're going to a trial balance, and that trial balance will become the basis for preparing financial statements. So in this next learning objective, we're going to move on to this trial balance. So the trial balance is really nothing more than a listing of all of the ledger accounts into their debit and credit columns. And you're just going to add them up. As I said, accountants don't do too much except add or subtract. So we're just going to get these columns and add them up. But there's a purpose for it. The purpose for doing this is that we want to be sure that debits equal credits. The main thing to understand is that the trial balance does not prove the accuracy of the accounting. It just means that debits are equal to credits. And there are lots of errors that could occur throughout the process. So it doesn't involve any accuracy. It just means that debits equal credits. The other thing to remember is that a trial balance is not a financial statement. It is simply a tool or a device that is used to help us prepare financial statements. Now, here are the reasons why you probably could still have errors even though a trial balance balances. You forget an entire transaction, right? You don't journalize it, right? It doesn't show up in the accounts. Or you make the journal entry, but you don't post it. If an entry is posted twice, debits will still equal credits. So for example, let's go back to our, if I still have the first example, I'll make it up again. All right, so here's the first example. So let's have cash and common stock. Here's the correct transaction. But you post it twice. That's an error. Now again, the balance debits are equal to credits, but the trial balance is not correct. So you could post a transaction twice and still wind up with debits equaling credits. So debits could be equal to credits, but again, you don't have a journal entry prepared. You prepare it, you don't post it, and you post it twice. Okay. Now, the other one, or the other problem, is that an incorrect accounts are used in journalizing and posting. So what I could have done, for example, what if I did this? When I sold the stock. In transaction 1, but instead of crediting common stock, I credit retained earnings. It's the wrong account. It should have been common stock, but the transaction will still balance out. So you could use the wrong account and still have the trial balance. Okay? All right, and the last possibility is that you could have offsetting errors. So what that means is that you can have, in one account, you could record, instead of 30,000, you record 60, and in another account, you don't record anything, you record 0, and it should have been 30, so you offset. So you put too much in one account, not enough in another, and it could zero out, or it could offset. So all of these means that the debits equal to credits do not prove the accuracy. Now, let's see what a trial balance would look like. And here are some numbers. These are taken from, let's say, a next period or another time frame. And you've got cash, accounts receivable, and this is what the trial balance looks like. Again, this assumes, I'm just going to tell you, it assumes that it's the first year of operations because you don't have any retained earnings up there. So they have cash, accounts receivable, office supplies, prepaid rent. They have office furniture, buildings, land, and then they also have accounts payable and the like. You should notice that all of the accounts are listed into their debit and credit columns. You're not, and this is a good question because I had one before about do debits always come first. When you do a trial balance, you're going to list them in order of their account numbers. So if you remember, you go back and you look at the chart of accounts, the chart of accounts would have cash as account 101, you'd have accounts receivable as account 120, and so on. So again, they are listed by account number, not necessarily by debit and credit. All of the assets come first, then the liabilities, then the equity accounts with revenue and expenses to follow. And again, it is your first year of operations, so there is no beginning retained earnings. I'll get back to that. All right, so again, what's the order of financial statement preparation? That's never going to change. So if you remember back in some of the earlier learning objectives in this chapter, how do you prepare financials? What comes first? The income statement, statement of retained earnings, balance sheet, and then cash flow. We're not going to go back to cash flow for a while. So for us, we're just going to be working with balance sheet, income statement, and the statement of retained earnings. But again, income statement first, retained earnings statement second, and then we move to the balance sheet. All right, so here's the, you want this? Okay. So here's the first step. We're going to prepare the income statement directly from the trial balance. Now, where do these accounts come from? These are coming from the T accounts. So all you need to do is to take all the balances from the T accounts and list them in their debit and credit columns. So we prepare the income statement first. just to review this again, notice the heading, the name of the company, the name of the statement, and for the month ended December 31st of 2014. So again, revenues are 16.5, and that's coming directly from here. So those are your revenues. Next, the expenses, we're listing them, again, not in this order, but we're listing them in order of magnitude. So the largest expense comes first, and that would be the salaries, and then the rent, and then the utilities. So the net income for the period is $10,800. Now, that net income is needed for the retained earnings statement. Mark? Yeah.
So in order to put the order of the expense, so salary should be first.
Yeah, the largest number is first. Right, the largest. Unless, as I said, when we cover this, in case there's a special reason why, let's say, advertising or research or something the company does to highlight that expense, you might put that first. But for us, we'll put them in magnitude or in size order. Okay? All right, so again, that's your income statement. Now, what happens to that net income number? And again, make sure, does anyone not understand that those numbers are coming from the T account? So let me just make sure that, let me go back to that. Let me just be sure that that's clear. So what will happen is if I was going to prepare a trial balance, I'd be looking in here. So, we had office supplies, I guess, of 500 in our example. We had land of 20,000. So we would take all of these accounts and then transfer them to the trial balance. So the trial balance comes from the general ledger. Just want to be sure we understand that point. So the trial balance comes from the general ledger.
It's just the balance of everyone?
Yeah.
So if you have two accounts?
Yeah, so cash, okay. We don't have the same numbers that we have in the example, but cash would be 10, office supplies, and then, of course, the land. Accounts payable was 5. And then common stock is going to be 30. So if I wanted to, let's just use this example. This is where we were in the other learning objective, but just to make sure you understand how this would work, if I was going to do a trial balance, I would be taking these numbers. So if I was going to do the trial balance, I would simply list these in their debit and credit columns. Right? So if I was doing a trial balance, I would then have cash of 10, and then I would go to office supplies of 500. Then I'd have land of 20. Then I have accounts payable. I'll move this up for you. I'd have accounts payable of 5. I'm sorry, it's going to be a credit of 5. And then I've got common stock of 30. So the debits are 30,005, and the credits are 30,005. So that's how the process would work. All right, so if you wanted to bring this out, let me bring this out a little bit. So that's how it would work. Your trial balance is prepared from the ledger accounts. Okay? So the trial balance is prepared from the ledger account. So if your cash balance is 10, you just move that over. At the end of the period, your office supplies are 5, land is 20, accounts payable is 5, and common stock is 30. Okay, so that's how it's done. Yes, Deanna? Yeah, the income statement, right, on the income statement. And probably even on the statement of cash flows, the largest numbers. And that's just a style. You don't have to do it that way. Yeah, you don't have to do it that way for homework, but typically that's the way it's done. Okay. All right, any other questions? Okay. All right, now, my next question for you will be, what's the next statement? The next statement would be the statement of retained earnings. And the reason why we need to do the income statement first is because net income gets transferred to retained earnings from that income statement. So again, the next statement is the statement of retained earnings. The income from the statement or the income statement is needed and this is part of the notion of articulation. And then, of course, any retained earnings goes to the balance sheet. So what will happen is when I'm preparing the retained earnings statement, again, the name of the company, the title, and for the month ended or for the 2 months ended. As I mentioned, for some reason, there's no beginning retained earnings here. If there is, you just add it. Net income comes from the income statement. So the income statement's here, and that would be put on the statement of retained earnings. And then dividends, again, are not expenses. Dividends are distributions of the retained earnings. So the next statement that you would prepare would be the statement of retained earnings, and that would give you a balance of $5,800. Now, that is needed for the balance sheet. So what I want to be sure, and I know that this example, coming with a beginning balance of 0, just even if there's a number in here, the number for retained earnings is not the final number. You can't use the trial balance retained earnings number in your balance sheet. You have to wait until you prepare the statement of retained earnings. Okay, any questions on that? Because we want to do the balance sheet next. All right, so now to do the balance sheet, let's see that next. Okay, there it is. Okay, the balance sheet, Smart Touch Learning balance sheet, that's going to come from the trial balance. And again, let me just remind you, this retained earnings account is not on the trial balance, correct? You don't see it on the trial balance at all. So everything comes from the trial balance. Cash goes into the cash account, accounts receivable. So everything from the trial balance will be moving into the balance sheet, the assets, the liabilities, and the equity account. So let's make sure this is very clear. Cash, accounts receivable, office supplies, furniture, building, land, those are the assets. Those come first. Total assets are $114,700. Then the liabilities, accounts payable, utilities such as electric and gas, unearned revenue, which is advanced collections, long-term notes payable. Those come across as your liabilities. Total liabilities are $60,009. And stockholders' equity, common stock is $48,000, but the retained earnings is not on the trial balance. And even if it was, you don't use that retained earnings. The retained earnings you see there is the retained earnings that we see on the statement of retained earnings. So the process, again, is going to be from the journal to the ledger to the trial balance and then to the financial statements. And when you look at some of these assignments, that's the way they should be built. Now, just a couple of other things here just to show you how the bookkeeping system really works. But before we move on to that, anyone with any questions on this? Yes, there's a question. I'll repeat the question. Yeah. Okay, what's the relationship between prepaid? Okay, what's the relationship between prepaid rent and rent expense? What happened probably, and I don't have all the information here, but what happened here is probably you've got, let's see, rent expense is 2 and the prepaid is 3. So you paid rent in advance and you might have paid a total of $5,000 for the month, right? The total that you paid originally. And what will happen during the year is that you might have had 2 transactions or 1. So let's assume it's 2 transactions. So it may be that and rent expense and let's say it's the current amount that's due. So rent expense is what, $2,000? And that's cash. Let's just say it's for cash. And that's 2. At the end of the year, so let's say the second transaction for rent is that you prepaid rent in advance for future use. So let's say on December 31st of 2014, you pay $3,000 for next year. You gave the owner of the building or the office space or the storefront, you give that person the money up front. So the person that pays it has an asset called prepaid rent. And that becomes an asset because you didn't use up the rent. They still owe that to you. Okay, that's a real good question. That $3,000 will be an expense for next year as you use up the office space. Yeah, you have to take, it's an asset now, but next year as you occupy, and then it goes into rent expense. But I don't want to go, those are adjustments we have to make, but that'll happen. So as you use it up, it'll be a rent expense. That's a little bit ahead, but it's a good couple of good points there. Okay? All right, so these are possible transactions that you could have had there. So it's a good question. Okay. Anything else on the trial balance? All right, now just to show you what the formal accounts look like in a system, let me just change this for you. All right, they have these 4-column accounts, and you know what they mean by 4-column accounts is that there's a debit and credit for the transaction, and there's a debit and credit for the balance. But the most important thing here is the referencing. The most important thing is the referencing, so that you have to be able to trace the transaction back. Now, this is used for information systems. If you want to be an accountant and you go into auditing, how do you trace a transaction? I need to know where the transaction came from, the journal, and I need to know where it was posted, what account it was posted to. So you have to have posting references. Now, if you look at the cash account, this cash account, it's an informal T account, but notice when you look at this 4-column account, it's got, there's your first transaction. The first transaction is going to be for the investment by the owner. That was a debit to cash and a credit to stockholders' equity. The cash account is 101, and where did this come from? Well, I put a posting reference there, and that's page 1 of the journal. So what this means is that you have the first page of the journal, and that's where that transaction comes from. You also have, let's just take the second one. They use $20,000 for land. That's a credit to cash, and there's the balance. So notice how the 4-column works. Debit and credit for the transaction, and then the balance has a debit and credit column. And if I needed to, while I'm looking at this ledger account, if I have any questions, I know I go to journal page 1, and that's where I find that account. So it's a cross-referencing system, and we'll also cross-reference the cash account. Yep. Yeah, if you had an overdraft, it would be sitting here as a credit balance. See, the normal balance here is a debit of $12,002. But if you had an overdraft, it would actually fall into the credit side. Now, if you take a look at the next page, here, this is the way it really works, where, let's go up here and take this example. On Exhibit 2.9, as it's called here, if you take a look at the journal entry, this is page 1 of the journal, and in the ledger, that's account number 101 and 301. So let's just post the first entry. So let's go back, and this could be common stock or capital, whatever it is, it's equity. So in the first entry, you debit cash and you credit common stock or capital. Now, that's in the journal. When I post it, I debit cash and I credit the capital account. Now, how do I cross-reference it? Up in the journal, if I wanted to find out if this was posted correctly, I know the cash account is 101, and I can go down to the ledger and find that account. If I wanted to look at the capital or the equity, account number 301 is also in the ledger. If I wanted to see where the transaction was originally journalized, I could go back and I find it on the journal. So the cross-referencing leaves an audit trail, and it allows you to, again, trace transactions back and forth. So the book of original entry is the journal. The book of final entry would be the ledger. So again, the system of cross-referencing is designed to make sure that you could trace transactions throughout the system. And then finally, when we look at articulation, let me go here, just to make sure, before we leave this, just make sure you're very comfortable with the notion that the financial statements tie together. So these are statements from a different period, for example, and or the same period, I should say, but all the transactions tie together. So once again, all the statements tie together, I should say. So income statement prepared first. Net income from the income statement goes into statement of retained earnings or owner's capital, and that gives you the retained earnings or the ending balance of capital, and that goes into the balance sheet. So all of the statements tie together, and that's known as articulation. So you have to be comfortable with the way the statements tie together. Okay? And finally, this is the cycle that we have now, and this cycle is going to be changing as we move along. So again, you have source documents, journal, ledger, trial balance, financial statements. So right now, this is the accounting cycle that we're going to be dealing with. Okay. All right, now, a couple of questions for you. Okay. We know that, by the way, again, I'm not going to ask you this one, but the trial balance is only the equality of debits and credits, not the accuracy, so that's going to be false. Okay? That's going to be false. Okay. Well, let's do the next one. All right, what I want to know here is which of the following statements correctly states the effect of the error. And here's the error. The journal entry for $75 for rent expense was inadvertently posted as a debit to salaries expense and a credit to cash for $57. So when you look at the trial balance, what's going to happen? Okay. Now, the big one error here, I know you don't have to worry about. One error is that they should have debited rent expense instead of debiting salaries expense. But what I want to know is the numerical inequality here. The balance will not balance. I need to know what's going to be the effect. Make the journal entry. Anytime, what I want you to start doing is making journal entries. If you do these in your head, you're not going to be able to do it. So if you're laying down with an iPad and using an RU Wireless, which is horrible, you're not going to be able to answer these questions. All right, so make the journal entry and see what happens. Make the journal entry and see what happens. Okay. All right, so the answer, by the way, is that if you make the journal entry, what I would do, here's the way the entry was made. The entry looked like this. So, of course, this, first of all, should have been rent. So we know that's wrong. But aside from that problem, the debits exceed the credits by 18. Right? So it's an $18 excess debit in this case. Now, to correct that, of course, you'd have to reduce cash as well. Okay? All right, so the answer to that one is B. The answer is B. Okay, any questions on that? Okay, I have one more. Now, according to Rutgers time, got 6 minutes to go, and I'm going to ask you one more question. And what I want you to do is answer the following. You need to find out how much common stock should be in this trial balance. All right, so how much common stock would you have in this trial balance? Okay, and there's an easy way to do it. If I'm asking you a question about a trial balance, why not make one? So why not make a trial balance? You may have to use a piece of paper and some pencil. Make up a trial balance and let me know what you get. Okay, so start the clock now. Doesn't have to be formal, just list things in the debit and credit column. Wow, it's kind of a split. All right, let's see. All right, anyone in the second half of the room, who got it right? Second half of the room. Who got the correct answer? Who thinks they got the correct answer? What is the correct answer? B. All right, so it is B. All right, so Jeffrey, how'd you do it? You got it right, or you just raised your hand? Got it wrong. All right, all right. So all right, the correct answer is B. So let me just make sure we got that recorded. All right. Anyone else get it right back there? All right, Ian, I know. Anybody else? All right. How did you do it? You got it right? Anyone back? People in the second half of the row don't get it right? Javier? Anyone? Javier Lopez? Is he here? He's not here. Anyone else? What about, oh, I'm thinking. Oh, someone with a big M. Michigan. Or an M. You got it? Yeah, did you get it right? How'd you do it? You don't really know. Okay. Well, at least you get the points right. Okay, Tom? Yeah. Yeah. All right, so what he said it's good. What he did is he got all the assets, liabilities. He did it that way. And then without any dividends, he was able to back into the number. All right, yeah, good. Anyone else? Yeah, good. Okay, and then plug that in. Yeah, okay. Yeah, so you could do it that way. You could do it by the accounting equation. Well, I just did this. I mean, now I just did this. Okay, so I just said, look, I mean, I sort of cheated, right? I just took all the numbers on there and I just moved them into their debit and credit columns, and I said, what do I need to balance? So I took all the debits. Let me focus this if you can't see it. Okay, so here's what I did. I just took, look, I mean, there's my comment I just said before. If you hold down, if you got to build a trial, if you have to solve for a trial balance, just build a trial balance. That's all. So there's no order. It's not fancy. I just took the credits into one column, debits in the other. Debits exceeded credits by 8,250, and that was my answer. All right, so it is B.